We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alasdair Macleod, the head of research at Gold Money. Thanks for joining me today, Alasdair. It's a real pleasure to have you back on the show again.
Thank you for asking me, Tom.
So, Alasdair, I wanted to chat with you today about your recent article that you wrote ahead of the BRICS meeting coming in August here. Of course, the title of your piece on the Gold Money website is called "Why the Dollar is Finished." I've gotten a couple opinions on this subject, but I'm looking forward to digging in more with you into this subject. So how long has, let's say, consideration for a new trade settlement currency been in the works for?
Well, it's been in the works for some time. We're absolutely certain that it's been in the works since Russia invaded Ukraine and the West imposed sanctions on Russia. Because following that, Sergei Glaziev, who is probably the most senior economic advisor to Putin, and I'm sure the most respected of economic advisors that Putin has, was appointed to look at establishing a new trade settlement currency for the Eurasian Economic Union. Now, this is a bit of a Trojan horse, I think, because the whole idea behind it was simply, you had a number of countries in the middle of Asia who were having to use dollars to settle transactions between them. And this didn't make any sense as far as Putin and Russians were concerned, and also the Chinese, who are also in the Eurasian Economic Union. So Glaziev had a clear mandate to come up with a currency which was additional to national currencies, but would be used specifically for trade settlement and presumably commodity purchases. And another part of the brief was that it should be available to other nations, presumably the Shanghai Cooperation Organization, its associates and dialogue partners, available for them to join in and to use this new trade settlement currency. It started off with a statement that, the sort of rough plan was to incorporate a mixture of elements into this currency, the currencies involved, the commodities, certain commodities, and presumably the commodities which would have been traded between them and so on. It was complete nonsense, actually. Glaziev, I think, knew from the outset that the way this should work is to tie the currency to gold. Now, that can actually be very, very easily done, and it would require the setting up of a separate issuer of a currency backed by gold, not acting as a central bank, sort of regulating and ensuring the integrity of the commercial banking network, not managing interest rates. It's just purely a bank of issuance, as it were. And so that was the concept. And I wrote an article designing such a currency. And I mean, if I can do it, for goodness sake, I mean, Glaziev's already there because he's a very shrewd individual. There was confirmation that was the direction in which he was thinking, because he wrote an article for Vedomosti, which is a Moscow business paper, on the 27th of December. On a slightly different line, he was writing that it was time for the ruble to go onto a gold standard. And that was co-written by his deputy on the EU committee. So this, I think, had some weight, if you like, in the sense of the deliberations of that committee, as well as this article being about how the ruble should secure credit, ruble credit should secure its value against gold. He was also the moving light in expanding the Moscow Gold Exchange, admittedly in the wake of Russian gold being banned from the London market, from the LBMA, both refiners and also, sourced from mines. So he came up with plans to expand that as well. I don't know how that's going, but you can see that this is a man who understands that you need to anchor credit to gold in order for that credit to retain its value. Now, this is particularly attractive to Putin because if you look at the Russian economy, you can see that interest rates are something like 8.5%. That's the overnight rate set by the Bank of Russia. The 10-year ruble government bond yields 11.5%. The ruble is weakening. I mean, it was sort of trading between 50 and 70 in the wake of the invasion, having shot up to 140. I mean, up is weak, as it were. The low figure is strong. These are against the dollar, and now, of course, it's up. It's drifting lower and lower and lower. And at the moment, the rate is about 90 to the dollar. So, and also, if you look at what's happened to commodity prices, they've tended to drift off, and the result is that the very substantial trade surplus and therefore budget surplus from exporting commodities, and particularly energy, that has shrunk down to a very low level. So you can see that as far as the West is concerned, they must be watching the Russian economy and thinking, we've got them, they can't afford to fight this war for very much longer. We just need to hold on and Putin will be in trouble. There is no doubt those pressures are mounting. But Putin is no fool. I think it's very likely that part of his agenda is to move towards gold to back the ruble. Of course, the benefits of that are that once the relationship settles down, you're looking at interest rates not 11.5% for 10-year government bonds. You're looking at 3%. You're looking at a far lower cost of capital for investing in businesses. You have a currency which is absolutely stable. It means that savers are going to be feel far more secure with their savings in the banks and so on and so forth, because the value of the credit that they get from a bank, which is what a bank deposit is effectively underwritten by gold. So you can see that there is every good reason, just don't tell the Keynesians because they don't understand it, but you can see how important this could be as far as Russia is concerned. If I had anything to do it, I would certainly recommend Putin to go down that route, but I think he's already there. So that now brings us to the overall strategy. The trade currency, which Sergei Glaziev has been working on, obviously there are political hurdles, which he's had to overcome. I think he's probably overcome those. And I think it is the basis of the new proposed trade settlement currency for the enlarged BRICS membership. Now, we will know for definite at the BRICS summit on the 22nd to the 24th of August, which is being held in Johannesburg. So that is a key date in everybody's minds. Now, I mean, when you look at a lot of the commentary in the West, I mean, for a start, the mainstream media, as far as I can see, has said absolutely nothing about it. But note that just literally in the week following this confirmation from Russia that this was going to be on the agenda, you had the US dollar's trade weighted broke down below a very important support level. It's rallied back in to test that support. So, we'll see how it pans out, but it doesn't look good. The chart looks actually pretty ropey. And the other thing is that you've had one or two dissenters which have sort of rather confused the situation. The Indians, some of the, less important Indian politicians have said there's absolutely no way we're going along with this. And, it's got to be a unanimous vote at BRICS, incidentally. So all of them got to support it. Bear in mind that India has tended to follow a very Keynesian line, and it has always denied, at government level, always denied the utility of gold as money. They have always wanted to have the rupee as state as the state currency, and as a result, I mean, over the decades, the purchasing power of the rupee has declined and declined and declined. But I don't think they're going to have any choice in this, because the people who are driving this are Russia. And you've got to think in terms of where they are at the moment. I mean, so far, in order to encourage future membership of BRICS, the Saudis and the Russians and the Iranians and the Chinese have said, we will accept any currency other than the dollar for your export. So the point is that, and this was something that Lavrov, the foreign minister, said, and this was back in January, so some time ago. He said, they've managed to accumulate quite a few Indian rupees, which they can't do anything with. Because the way the foreign exchange markets work is that, if you want to sell your rupees, you have to sell them for dollars first and then buy rubles. But guess what? They're cut off from dollars. They can only do it via China. It really means that these currencies are completely worthless to Putin, and they're not worth very much more to the Saudis, let alone the Iranians. So you can see that was very much an interim measure. Mm-hmm. And I think that what we will see at the BRICS summit is we will see statements from Russia that henceforward they're going to sell either all their energy or some of their energy or whatever in this new gold-backed currency. So I think this is, this is almost a fait accompli. In the West, nobody's paid any attention to this whatsoever. And I think that is a huge, huge mistake. So we could find, and I think it's very likely we will find on August the 22nd, 24th, that something major has happened. And incidentally, by confirmation of this, again, the week after Russia announced this new gold proposition, Janet Yellen went to Beijing. I have no doubt what was on her agenda, and that produced absolutely nothing from the Chinese. And then they send old man Henry Kissinger, 100 years old. He didn't go there for his health. He was obviously requested by the U.S. government, whether it's deep state or wherever, but requested by the U.S. government and particularly the U.S. Treasury to go and try and talk the Chinese out of this. The argument being that this would threaten their exports to, if it undermined the dollar, it would threaten their export values to America and all the rest of it. But I can tell you the Chinese are not listening to that. They are more concerned with keeping their project together. And in doing so, they realize that the vulnerability of a lot of these potential new members of BRICS is what they owe in dollars. And higher interest rates are creating real distress for them. And this is one of the reasons why they want to get away from America, because they don't, this has happened, time and time before, and they don't want this squeeze to continue to happen. So you can see that this is a multifaceted, very, very big story. Anyway, I think that's probably enough to be going on with that.
Absolutely, Alasdair. And I appreciate that thorough explanation. It kind of ties a lot of those details together, a lot of the, let's say, the incentive structure together. But maybe we can start with, how do we know that nothing really came out of that meeting when Janet Yellen went to China?
Well, we don't know. I mean, at the press conference afterwards, someone asked, what about this new go-back currency? And she avoided the subject. She just said, the dollar is used for over 90% of international transactions, and it's going to continue to be the so there was that sort of waffle, if you like. We don't actually know the agenda of these meetings. Of course, we don't know. But what else could it be? It's not. I haven't seen you for a little while, Mr. Xi. Lovely to see you, Mr. President. How are we getting on? Yeah. This is a bit more serious than that. I mean, the other thing which undoubtedly is in the back of her mind as Treasury Secretary is that China has been selling off its U.S. treasuries, and it's still got quite a lot. And I think its policy towards retaining U.S. treasuries is something which is obviously very, very close to the Treasury Secretary's heart. So I'm sure that was part of the conversation as well.
So, Alasdair, let's dive into a couple of the, let's say, the intricacies of this. Is this a particular currency that we're talking about that is only facilitating trade between countries and not for use at a retail level at this time?
That is correct. It's trade and the purchases and sales of commodities, settling commodity transactions and trade. Now, the thing about trade credit is that it is mainly self-extinguishing. So, if you're shipping goods from A to B, you need to facilitate the transfer with credit. And of course, when the goods are arrived and it's paid off, the credit is extinguished. So this is, in that sense, very, very different from bank credit within a country and the role of that credit within the country. And it's not something that would be available to ordinary citizens. Now, this means it would be available to businesses, but I believe one step removed. So if, let's say, you're an importer or an exporter, you will need to get finance for this credit, if you like, through either a nominated major bank which has access to the facility, or probably, that's probably the best way to do it, because that bank would then have access to the new currency through its central bank. So you can see that it's just credit created on the back of this new currency. Because, almost all currency is not money in the sense it's gold. It is actually something which is tied to gold in this case. And that is the key thing. So it's actually not too difficult to do. And I think the other advantage is that by not interfering with individual governments' management of their own domestic currencies, this being something extra, it means that the sort of the politics of the whole situation is made a lot simpler, which is why the original proposition which Glaziev was talking about, that this new currency would be some sort of hodgepodge of, currencies of the countries involved and all. That just made no sense at all. And every time someone wants to join in, you have to reweight it, rebalance it. That's not going to work. There's no certainty in that at all. But we know what the price of gold is. We know what the value of the gold is. And we know that if the credit is tied to that, and not only tied to that, but irrevocably tied to that, then, what's not to like about it is actually quite simple. It makes values that much simpler. The big problem, I think, will be dealing with commodities, the purchase and sale of commodities, which would have to go to a reference price, I think, in dollars, because that is the international way in which these are priced, but then translated into gold. So there would be a step, I think, when it comes to commodity purchases and sales, particularly if you're buying commodities, say, from someone who's not a member of this BRICS organization. And incidentally, amongst the attendees are virtually all the Shanghai Cooperation Organization members, associates, dialogue partners, which rather suggests to me that another thing on the agenda is likely to be a proposal to merge BRICS and the Shanghai Cooperation Organization. Now, that would, I think, send a very, very clear message to us in the West that this is a supra-organization of many, many nations which are coming together away from us, on commercial terms, which is the key thing, to trade with Russia and China.
Is there a very appreciable difference between the members of the BRICS and the members of the SCO?
Yes, there is. Yeah, basically, the Shanghai Cooperation Organization has always been for Asian nations, and if you look at the members, and as I say, the other two categories are associates and dialogue partners. These are people or nations which intend to join in the fullness of time. They're all Asian, basically, all Asian. And none of them are outside Asia. But BRICS, apart from Russia and China, you're looking at India. Well, that's Asian, isn't it? But you're also looking at Brazil and you're looking at South Africa. And if you look at the list of other countries, there's a whole raft of them from sub-Saharan Africa. Well, Africa as a whole looking to join. And why should they join? Well, I mean, China is making major investments in these countries, and a lot of this is on a partnership basis. They're improving, sort of rail links and roads and things like that. So communications throughout Africa are going to take a huge, huge leap forward. And so this is a very different thing from the way in the West, we in the West have approached our relationship. We basically ignore them. We chuck a little bit of, development money at them, as it were, which generally ends up in someone's pocket and doesn't actually get anywhere. So it's, we sort of end up basically bribing the politicians to stay on side. And America in particular, through the IMF, has lent them dollars on nice, easy terms, which suddenly, when you find that interest rates start rising and these things start maturing, are no longer easy terms. So, this is a completely different thing as far as these nations are concerned. But as to your question, no, we've got two separate organizations: Shanghai Cooperation Organization, almost entirely Asian, BRICS, everywhere outside Asia, with a few major players in common.
Mm-hmm. You made that point in the article, Alasdair, with basically America raising dollar interest rates to the level that it has and keeping them there. Is it possible that they're trying to bankrupt these Latin American and African countries and try and force them back into the American sphere of influence, despite, as you said, China having all kinds of investments into their infrastructure and assets in those countries and creating a lot of, different projects that are worth a lot more than some superficial aid money, as you're kind of putting it.
Yeah, I mean, it's my view that this is not a deliberate act of policy by the Americans. But having said that, I think they would take advantage of it. Let me put it that way. I think what really matters is what the Chinese believe. The Chinese strategists in the past have analyzed America's behavior towards, regions, if you like. And there is a document which you can find online. I'm trying to remember the name of the Major General of the PLA, who's their chief strategy man. I think it's a guy called Cao. Anyway, he wrote that basically the Latin American crisis in the late 70s was effectively an American pump and dump operation, whereby having lowered interest rates, they then raised them, bankrupt people like Argentina, Brazil, whatever. And then American corporations walk in and pick up the pieces for nothing. And the other example, which this Major General quoted, was the Asian crisis in the late 90s, which led to the collapse of the Thai baht people like George Soros shorting it and driving the value of the currency down. Again, the same sort of thing. And it was all done on sort of the back of low interest rates, weak dollar, interest rates rising, strong dollar, bankrupt Southeast Asian nations. So now that's what the Chinese believe. And I think that's the important thing. And if you look at this current situation, you've got all these countries trying to migrate away from American control or control over by the Western alliance, as it were, into something which they believe to be better. And China is very much aware that the danger that these countries face is this sort of pump and dump operation. So they need to, as a matter of urgency, they need to ensure that that does not happen. And this is why the new development bank, which is set up in Shanghai, is tasked helping to finance these countries in trouble. And at the same time, Russia is offering something between 25 and 50,000 tons of grain to these countries as well for free. So you can see that there's quite a big sort of effort on the Russian-Chinese axis side to try and keep this whole thing together. This, I think, as far as the Chinese is concerned, is now more important to China than the value of its exports to America and so on and so forth. Mm-hmm. And the Chinese have seen how sanctions have backfired against Russia. And they are, I think, aware that if America or the Europeans, but it will be America more than anyone else, if they try and stop Chinese imports going into America, then I mean it's going to create an absolute disaster for America. Because just think what happens to prices. I mean, everything that would be imported from China, if they cut it off completely, if there's going to be an absolute panic. If they just bring in punitive tariffs, that's going to raise prices for the ordinary American. And it's going to kill American businesses too, because they can't import semi-manufacturers and stuff from China, which is necessary to manufacture things in America. I mean, the Chinese will have analyzed this in the light of the experience of the sanctions against Russia in particular, and in the light of their own experience from Donald Trump onwards. So this is, to my mind, I think they sort of take the view that there's a far more important thing to play for here, and that is our joint project with Russia to bring the emerging world together and create an industrial revolution for our mutual benefit, Russia and China, from our different standpoints, and also to ensure that, if you like, the old Mackinder belief that the center of the world in terms of power is somewhere in the middle of Asia, and that is actually what we're seeing playing out. I mean, he wrote that. His original paper was in 1905. So, Britain's on the periphery. You're on the periphery, and we've got this sort of the whole sort of Mackinder World Island thing looks like it's coming true.
Well, Alasdair, you said something earlier about who was driving this, and you said that Russia is really the only one or the main driving force behind this. And then you just explained how China is really interested in those same goals as well. So is it both of them that are really pushing for this?
No, I think it's predominantly Russia, but it's now with China's agreement. I think that's the way to look at it.
Yeah, because in the article you wrote that Russia's trade surplus has now fallen sharply, and the special military operation in Ukraine is a drain on otherwise healthy government finances. Because of these factors, President Putin needs to act soon to bring his SMO to a conclusion, or alternatively act to drive commodity prices higher, which is the same thing as undermining the purchasing power of the dollar. So how would he go about acting to drive global commodity prices higher?
Well, by undermining the dollar. And, I think when this announcement comes out, if I'm reading it right, I may be wrong, but it seems to me extremely unlikely that, nothing will come out of the conference, particularly since the Russian state media has said it is on the agenda. I think the very fact that there is a new trade currency, and that is, in my mind, likely to be followed by the ruble going on to a gold standard, and also China. And it's that will undermine the dollar, because what they need to do to get this to work, quite simply, is they need to have a better alternative to the dollar for trade settlement purposes. And that's the point behind this. This is why gold is central to the whole thing. And I mean, but it's not just a new gold-backed currency and suddenly the dollar collapses. But if you just look at what's going on in the U.S. economy, they are in an impossible debt trap. There is no escape now. The economy is just ensnared in debt. And if you look at the U.S. government's interest bill, I mean, that's now running towards $1 trillion. And, we are actually heading for higher interest rates. Why do I say that? Because bank credit is contracting. What happens when bank credit contracts? Well, the cost of getting, sort of borrowing, if you like, out of a bank goes up. If it's available, they'll turn. You go along to your bank and say, well, we got this facility of, $10 million. You sent us a note that it was going to be reduced to 2.5 million. we need to have that flexibility because our sales are slowing down, our costs are increasing. We've got a cash flow problem. We need to have some credit. And the bank will say, well, look, times are very tough. It's the old story about when it's raining, they take the umbrella away. But what it does mean is that the cost of credit in the sense of interest rates is going to rise. And it's got, this is completely independent of what the central bank, the Fed and all the rest of it say. They've lost control of interest rates. This is the point. They no longer have control over it. And the other thing is that we're beginning to see, if the dollar does weaken, we're beginning to see the inflation problem coming back. We've already seen grain prices rise as a result of Russia refusing to extend the supply agreement from the Black Sea. We've also seen the oil price move up. That's gone up about 18% in the last month or so. This is a trend which looks like it's coming back. And this is not good for future inflation, if you like, in the sense that the Fed follows it through the CPI. The ECB does the same. And the other thing we're finding also is that there are cracks appearing in the Japanese financial system because the Bank of Japan has been forced. I mean, it wasn't put like this. It was just said that, they've changed their target. Well, actually, if you look at the situation, their balance sheet is just fearsome. I mean, the losses that the Bank of Japan has, having done QE all the way from the year 2000, ramped up the prices to buy its bonds at the lowest possible yield, or rather the highest negative yield you can imagine. And now they're in a position where they can't actually buy any more. The reason that they have changed the levels of intervention and targeting and whatever is simply because they can't keep it together anymore. They're forced into it. And we're seeing that rate shoot up. I mean, I think it's about 0.61%. It's the highest it's been for 11 years. Now, this has knock-on effects because what do the Japanese banks do? They start selling French debt, for example, because they've been fairly heavy investors in French debt. They will sell our debt. I mean, and, this is, you've got sort of storm clouds gathering over the currencies, irrespective of this new BRICS currency story. We're actually killing our own currencies and economies without that happening. Mm-hmm. So what we're actually looking at is we're looking at the end of the fiat currency era, which has lasted from 1971. And, the end of that era, whether it happens slowly or quickly, I don't know. I mean, I think it was Hemingway who said, you start going bankrupt slowly and then quickly. And I think that's probably the sort of situation we're in.
Mm-hmm. Well, you mentioned all of these, let's say, financial symptoms that are cropping up here. Is the dollar facing, and a lot of these Western fiat currencies facing the same fate now as John Law's currency was in the 1700s?
Yeah, that's a very good point because there are similarities. You have if you like, an asset bubble, which was what the Mississippi bubble was. It was an asset bubble, but it was concentrated just in one country. Mind you, having said that, there was also a bubble. It had the South Sea bubble running at the same time in London. There were different dynamics in that, but the point about the Mississippi bubble was that it was blown up by John Law's credit policies, and we have the same thing today. The central banks have been blowing bubbles everywhere by suppressing interest rates. So we have a situation which is very similar to John Law's, except it's on a global scale. And, I've said this so many times, but, Richard Cantillon, who was active in Paris and London at that time, took the view that the way to play this was to short the currency. And he was dead right, because from February 1720, the Mississippi shares fell from around about 12,000 livres down to a low of about 4,000, maybe slightly less, by the following September. Whereas in the last quarter of 1720, there was no quote at all in London or Amsterdam, which were the two main foreign exchanges at that time, for the French livre. So, that was the one to short, as it were. And that's what he did. He sold every French livre he could possibly get his hands on, having liquidated all the stock that he had as collateral and so on and so forth. I mean, that was a very, very shrewd move. And what he was betting basically was that, when the bubble collapses, it takes out the currency. And you can see today how this is going to happen. What is the mandate of the Fed? It's basically to fund the US government. So, they will try and ensure as much as possible that the fiscal demands are not onerous. What does that mean? It means stimulating the economy so that unemployment doesn't rise, so that welfare commitments by the US government don't rise. I mean, good luck to that. You can see where the reflation, the extra load of money printing, if you like, the expansion, if you like, of central bank money, where that's going to come from. It's going to be forced on the Fed. And it could be well forced on the Fed with interest rates hitting, 8, 10, 12, 15%. I kid you not, that is the sort of level which this could easily go to. And that would be so destructive. This is why it's important to understand that it's not just America, it's Britain as well, it's most of Europe, and it's also Japan. They're all in debt traps. And once you are ensnared in a debt trap, there is no escape, or no escape which is politically palatable. That's probably the better way to put it. And that's where we are. And of course, this is another thing from the point of view of Russia and China. They don't want to go down with us. They have got to insulate themselves against this outcome. And that, I think, is a large part of their thinking.
Mm-hmm. So, Alasdair, why do you think most economists don't see the end of the dollar in the same way? Like, you mentioned earlier that there's no reporting of this in the West in general, let's say. So Why do you think that is?
As to why there's no reporting, I just do not understand it, unless there's some sort of, we have a system in the UK where called D notices, and this is where the intelligence services and the Defense Department put out a notice to the press, banning them from reporting on the event, if you like, which may be arising. So this could be a D notice, but I don't think it is. I think it's just ignorance, if you like, of the importance of this. Remember that we've been in a purely fiat world now for over 50 years. The whole of the the education system, when it comes to economic degrees and all the rest of it, has basically dismissed gold as part of the monetary system. It has come up with it's entirely supportive of Keynesian stimulus, the use of credit, the manipulation of interest rates, and all the rest of it. You ask any economist about these matters, and they will come out with the same party line the whole time. They don't actually understand what interest rates represent. I mean, to a foreigner, and this is where the weakness in the currencies comes from, to a foreigner, just put yourself in the foreigner's shoes. You look at the dollar and you think, okay, if I'm going to hold on to these dollars, what compensation am I going to get? And one of the main things, apart from counterparty risk and so on and so forth, one of the main things is, and it's probably the most important now, is one's guess as to what the purchasing power of the dollar is going to be in a year's time. We know what it is today, roughly. What's it going to be in a year's time? If the foreigner thinks that the way things are moving, the purchasing power of the dollar is going to fall from where it is expected currently, then he's going to require a greater compensation in the form of interest rates. In other words, he's got to compensate for the discounted future value of the dollar. That's what drives the thing, not Fed policy. So if Fed policy is to raise interest rates to compensate the foreigners, then there's a possible chance that the foreigner will hold on. But even then, this is the problem with the debt trap, because you do that, the debt trap just gets worse. And the foreigner will probably think, oh my goodness, that might have been appropriate before they raised interest rates, but now they've raised interest rates. the economic effect is likely to undermine the dollar even further. So I'm going to require a yet higher level. Are they going to hang around for high? No, they just sell. And bear in mind that according to the US Treasury's tick system, foreigners own $32 trillion of financial assets, including $6.5 trillion of bank deposits, and cash. So, is it overowned? Of course it's overowned. In terms of the future use of the dollar, of course, this new super bloc of the Shanghai Cooperation Organization and BRICS, they're not going to need dollars so much. So they are likely to reduce their dollar holdings. And what they will do instead, what they should do is they will sell dollars for gold, because gold will be the new standard. Mm-hmm. And so that's why this undermines the fiat currencies. Full faith and credit is no longer good enough.
Well, that brings us, squarely into that idea of how foreigners own U.S. treasuries and U.S. cash. You made that distinction. So let's talk a little bit about this idea of these, countries that hold the U.S. debt, how they would go about getting rid of that. I had a listener recently send to me, and I can't remember the name of it, but it was called Operation something. And it was basically a coordinated effort by all of the countries in the world that hold US debt to sell it at the exact same moment to basically crash the market. Would that have any effect other than to spite the US? You would think that would create such a glut in supply of treasuries at that point that there would be almost no demand other than maybe the US Treasury to buy it all. And then they're stuck with dollars anyway.
I don't see that sort of situation in place at all. What I do see is each individual nation, as they do at the moment, taking their own view as to what they should, how many dollars they should have in their reserves, mm-hmm. and how those dollars should be invested. There are some elements of overseas investment, foreign investment in dollars, which actually is American by another route, and that is through, say, the captive insurance industry in Cayman, for example. You've got a fairly large holdings of U.S. treasuries in places from Luxembourg and other offshore centers. So those basically will be stable, and I think that they would probably buy more if you had an increase in yields. So that's not what we're talking about. What we're talking about is countries which would be going into this BRICS thing, if they can see that they're going to need to use this new currency in their reserves, then it will be a replacement situation. What will be important in this is the extent to which they will need to subscribe to this new currency. Now, if they have to subscribe to this new currency by submitting part of their gold reserves, then this would encourage them, I think, to sell dollars for gold. But, we will know more, I think, in the wake of the Johannesburg summit later on this month.
Mm-hmm. Alasdair, going back to this idea of, really the way that credit has worked in the US, we've been through a 4-decade-long expansion of credit and money supply here. Have things really changed with inflation being so high and persistent, combined with this contraction in credit from the commercial banks?
I've been looking at this question actually quite seriously, and I wrote a paper on this a few weeks back, looking at what actually drives the value of credit. And there are, in my view, two components that you've got to look at. The first is the cycle of bank credit expansion and contraction. We haven't seen an awful lot of evidence of this because it has been smothered by central bank action. For example, when we had the Lehman crisis, you didn't see bank credit contracting. What you had was the sort of crisis which suddenly happened, and basically the Fed and the US Treasury wrote an open check for the banking system. We will make whatever is available to save the system. And it did. It's, confidence was saved. So that is the sort of reason why, the bank credit cycle as such, we have seen the expansion, but we haven't necessarily seen the contraction. But the situation has now become so extreme that we are actually seeing the contraction. And it's not really all that evident yet in the United States. What we have seen is the rate of growth slowing down, but there's sort of other special factors. For example, quite a lot of this money or credit has gone into reverse repos at the Fed. So, you need to add that back in. You need to look at things like on the bank's balance sheets, the extent to which loans as opposed to deposits on the liability side have increased, because that, again, is another, if you like, complication in terms of analyzing this. But it is quite clear in the UK, it's quite clear in Europe that bank credit is contracting, not just slowing down, but actually contracting. And you have to bear in mind that GDP is basically the sum total of transactions funded by bank credit or paid for by bank credit. So if you get a contraction in bank credit, you're going to get a contraction in nominal GDP. Or at least you will, to the extent that the authorities don't come in and increase the quantity of central bank credit. So that's the cycle of bank credit is one thing. The other thing, in terms of contributing to the undermining of a currency, its purchasing power, is the central bank's activities. And I go back to the 19th century and the experience in Britain between 1844, when the the Bank Charter Act came out, which renewed the Bank of England's charter, and the First World War, a period of 60 odd years, the amount of banknotes in circulation, because the Bank of England from that charter was the only issuer of banknotes, basically. The quantity of banknotes in circulation hardly changed. Inflation, not inflation, but if we look at the level of prices, consumer prices and producer prices actually fell slightly over that period. There was some initial volatility as the situation bedded down. Part of that was an increase in the savings rate from around about 5% up to 22%, I think, in 1890 or round about then. So, these are the sort of dynamics you're looking at. But also what happened was that the expansion of bank credit was something like 6-7 times. Yet you did not have the inflation. Why? Because what happens is that apart from the cycle of bank credit, which is greed, fear, greed, fear, greed, fear in the bankers' minds, the expansion of bank credit basically is demanded by businesses investing in production. So you can see, or financing cash flow or whatever, so that you can see that the apart from that fluctuation, the expansion of bank credit actually meets the needs of the economy, and that's why it is not inflationary. But the inflationary bit, if the Bank of England had increased its note issue, then there is absolutely no doubt it would have undermined the purchasing power of the pound. The reason it did not increase the note issue was it was restricted by the Bank Charter Act, whereby it could only increase the quantity of banknotes or the value of banknotes in circulation by matching it with extra gold. So it was tied to gold, as simple as that. So if, let us say, the market demanded more notes, more banknotes, if there was an expansion of the circulation of that, then the Bank of England, in issuing them, would have had to buy more gold. So that was the way in which the system worked. And by and large, that's going to be true today. And this is why when you had the ending of the Bretton Woods system, before that, the rate of inflation was generally pretty subdued. I mean, if you look at producer prices, for example, the value of or the price of a barrel of oil was something like $2.56 or something in 1950, and in 1970 it was still about that. I mean, so it was very, very stable. But when we ended Bretton Woods, when that was suspended and you had free floating currencies, guess what? I mean, suddenly these currencies started losing purchasing power. And compared with then, I mean, the way to work out the effect is, a dollar was 1/35th of an ounce of gold in 1971. Okay. Today it is nearly 1/2000th of an ounce of gold. So you can see what's happened to the dollar.
Yeah,
that's the way to understand what's happening. Not way gold's going up. No. It's the dollar sinking, and it's the same for all our currencies. Incidentally, it's not just the dollar.
Alasdair, one of the other pieces of the article I'd like to go through here is how you put that activating gold could be the financial equivalent of a nuclear war here. So, how do we assess, let's say, the effect that this has on America's military power and NATO as well?
Well, quite simply, if the purchasing power of the dollar is undermined in terms of buying all the military equipment and paying the military personnel their some sort of living wage and all the rest of it, undermine the dollar and you undermine that. It's as simple as that. And I've always thought that, this nuclear, the financial war is escalating into something which is the equivalent of nuclear proportions. It is ultimately incredibly destructive of the fiat currencies. Like, it destroys them entirely, almost like you drop a few H-bombs on, I don't know, someone you don't particularly like, and you just wipe them out. It's a bit like that, but the financial equivalent of it. That's why I've referred to this as the equivalent of a nuclear war. It is a major development. And as far as Russia is concerned, it is this special military operation in the Ukraine. As far as it's concerned, Putin can't back down on it. I mean, he's making statements like, perfectly prepared to negotiate, but I can tell you that terms will be completely unacceptable to the Americans, because what he wants is America, just get the hell out of Europe, then I'll stop. So, but America equally, can't do that, particularly before the next presidential election. So you can see that, both sides are like that. The only person who has any credibility on the American side, I think, in this is Henry Kissinger, who said, look, and he said this, right at the outset, this is crazy. We've got to talk. Otherwise it's just going to get worse and worse and worse. And, I'm absolutely right. And there are other people who are now sort of coming out, seeing the dangers. Colonel McGregor, for example, is one who's very vociferous on this. And I must say, an awful lot of what he says seems to make very, very good sense to me. So, I mean, unless we actually defeat the Ukrainians, unless the Russians actually defeat the Ukrainians, I'm afraid this is, the only alternative I think Putin has to protect his own economy, his own credibility, and everything else is to escalate the financial war. And that, I think, is what we will see at this summit in Johannesburg.
Alasdair, do you think this is going to be, like a major step change in, or let's say the equivalent of a financial nuclear bomb? Or is it going to be, just another chink in these Western fiat systems on their way down?
I think it's a breach in the system. And I think it's far more serious than, just another event in the decline. Now, this to me is very, very serious. So, we'll see. I mean, I think most of the naysayers in this are sort of just don't believe it can happen, really. They don't believe that, while, an awful lot of people on our side of the fence, will agree that what we need to bring back gold into the financial system to give it stability and all the rest of it. The thought that this could be done quickly by the Russians, or led by the Russians in BRICS and all the rest of it. I mean, they think, no, this can't possibly happen. No. This is going to take 5-10 years. You get these sort of comments. And you also get other commentaries like, but the Indians said, they're not going to go along with it. And of course, they've got a veto. So you've got these sort of conflicting stuff, as it were, which is encouraging people to think that this is probably not the danger which it might seem on the surface.
Mm-hmm. I'd like to go back to thinking through the consequences for gold, if we can, Alasdair. You mentioned that if we just take the size of the U.S. Treasury market abroad, I think you said it was 32 trillion.
No, not Treasury. That's all investments, all foreign investments, long-term and short-term, of which around about 7 to 7.5 trillion is short-term. In other words, bank deposits, U.S. Treasuries, corporate, T-bills, corporate bills, and so on. Of the rest, roughly 14.5 trillion is invested in equities and the balance is in bonds. So that's the sort of split that we're looking at. And of course, another aspect of this is that if I'm right about interest rates, I wish I wasn't, but I can't see any alternative, then there is going to be the mother of all bear markets in financial asset values. And so foreigners will not hang around on their 14.5 trillion of portfolio investments in US equities, and nor will they hang around, on all the rest of it. So these flows could suddenly become very, very important.
Well, that's what I want to kind of do a bit of a thought experiment with you here is comparing, let's say, the size of foreign held US assets, let's just say as a complete category of that 32 trillion, and comparing that to the size of the gold market and what potential impact that could have when even a portion of that liquidity starts chasing gold.
Yeah, I mean, it's bound to have an effect. Of course it is. And I don't really think there's an awful lot of liquidity in the gold market, apart from anything else. But I don't think the liquidity coming out of US treasuries, out of US equities and all the rest of it is necessarily all going to go to gold. I think it will probably, quite a lot of it will go to China. Mm-hmm. The reason being that China is upping its investment around, everywhere. Africa, Asia, Latin America, and so on. So it wants the capital inflows, as it were. It can handle those because it's got a home for it. So I think that's where a lot of this is going to go. And also, I think you'll find that people will start stockpiling commodities. Because if they see that the purchasing power of the dollar is declining, then obviously what you do is you buy commodities that you might need in the future. So I think, those are the things that are likely to happen rather than it all going into gold. The quantity that goes into gold, I think, will be determined by the structure, if you like, of the new trade settlement currency to a large extent. Funk money as well. I can see this exposing problems in the West because quite a lot of central bank gold has been leased or swapped. So you've got two owners for quite a lot of it. We don't know how much that is, but I wouldn't be surprised if it is north of 10,000 tons, double ownership.
Which you would think would be resolved through, a switch to a newer system, right? Because you'd have to update. I think it would be resolved with a crisis, basically. I can see a crisis in the gold market. Mm-hmm. So I mean, you've got all these sort of disparate factors. But what I would like to say is that, my comments assume that the purchasing power of gold is not changing through this. All the change is coming from the fiat currencies. Right. I mean, of course, when you get a panic out of fiat currencies, it is going to drive the purchasing power of gold up. Is bound to. I'm not talking about in terms of currencies, but relative to other things, if you like, the things that we normally buy. Property is a very good example of this.
at the moment, I mean, property is an interesting one because until recently, everybody's been buying property on the basis of close to zero interest rates. Interest rates have started rising. You've got a little bit of a pause in the in the residential property market. Commercial property's got its different set of problems, but all related to the same thing: the cost of financing purchases. I think that as interest rates rise further, which would be accompanied by a fall in the purchasing power of dollars, pounds, euros, whatever, then those property values are going to fall even further, measured in those currencies. Meanwhile, in gold, of course, it'll be falling even faster, simply because the purchasing power of gold, I think, will not only reflect stability, but it will reflect a flood of money, realizing that its currency is going down, not gold going up, if you see what I mean. So it's going to be an interesting situation. And this led to, I mean, in the great inflation in 1922 to 23 in Germany, this led to property prices and farmland prices absolutely collapsing in local currency. But you could pick it up. I mean, if you had foreign currency, which in those days was dollars, the dollar was tied to gold at $20.67 to the ounce. You could buy and the other problem with property is that if you look at rentals, the rents that you achieve will fall in real terms very substantially, and they fall in a great inflation to the point where they don't cover the cost of maintaining the property. And when you get that situation, then the property is on its way down to zero value. It becomes a liability, if you like. This is, these effects are very, very far-reaching, Tom. And but if you've got gold, then you could probably benefit from it, because once the currency is destroyed, or once the situation's deteriorated to the point where the political class have the courage to try and stop the slide by readopting a gold standard, at that point you find that the value of property and so on and so forth will start rising, because stability will help it. So from that point, you should have, just ahead of then, perhaps spent your gold buying property or similar assets, if you like, the assets which we all need as part of our daily lives.
Yeah, I mean, it's going to be very interesting to see how this all turns out, Alasdair. And I think using history as a guide, looking at how that has happened before, you bring up the example of buying property in Germany, or buying an entire house, or I think it was an entire block for an ounce of gold. Yeah. It's just mind-blowing to think of.
Exactly. Well, I mean, foreign students studying in Berlin were reportedly buying streets of houses out of mummy and daddy's allowance. They get that monthly allowance, comes in dollars, and they run out and they buy houses with it. I mean, it was, the middle classes were bankrupted. Landowners were bankrupted. So some big estates changed hands. The people who benefited from this were very few. There was an inflation. Well, he was known as the inflation king, a guy called Hugo Stinnes, who at one stage owned roughly a quarter of all German. Of the German economy, if you like, sort of production, all the rest of it. Because what he was doing was he was exporting for hard currency, for dollars, which he used to buy this, buy that, and all the rest of it. Hugo Stinnes actually died in 1924, so he didn't live long enough to enjoy the gains as an inflation king. But you can see that. I mean, the whole thing was so disruptive that this led to a political collapse out of democracy into Hitler, who was elected on the back of this. He managed to gain power, and then he ruthlessly did away with any opposition, and the result was World War II. So this story doesn't end with the currencies, and we don't then sort of suddenly realize our errors, everything's wiped off and we live happily ever after. No, right. There are consequences that will follow, and they need to be managed by statesmen who actually understand where it has all gone wrong, and to avoid it going wrong again, and to understand that they need to hold on to power to see the transition back into economic normality. And the chances of that, good luck is all I can say to the future.
Yeah, we don't seem to be learning very well from history, as it often does rhyme. But again, I appreciate, Alasdair, you helping tie some of this together for us and see some of the pitfalls that might be arising. I think that's a good place to wrap up for today, Alasdair, unless there's anything else you'd like to add.
No, I mean, I do write for Gold Money, and if any of your viewers want to follow up, then Thursday is when I publish my article, and I do a market report on Friday. And what Gold Money does is we store precious metals in various vaults around the world, fully insured, in our customers' ownership, and it's not on our balance sheet. And we also have we also own Shift Gold, which does sort of coins and deliveries and all the rest of it out of New York. So that is another branch, if you like, of the Gold Money mini empire.
Perfect. And of course, your articles are all available. We'll link to this article as well in the show notes, but those articles are available at goldmoney.com. And of course, you're an excellent Twitter follow at Macleod Finance, right?
Thank you very much indeed.
Thank you, right. Alasdair. I really appreciate your time today and going through all of this with us.
My pleasure, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.